Hello, everyone. I hope all of you are doing great. Uh, Welcome to this exciting third and one of the most important live class for the September 2023 exam sitting. Okay, now this particular live class is all about audit risk. And I have got a huge assumption in my mind, and that is you guys are done with the lectures relevant to the risk and planning. More importantly, you have attended lectures relevant to the CRQs on audit risk. You have actually typed those risks and you have attempted the assignment number one as well. So that's a huge assumption. And with this assumption and with this confidence, I want to start today's session. Now, from where I need to start, well, I will proceed this class in a very different way. Now, when you are going to attempt your AA exam, if you are going to attempt in the morning slot, if you are going to attempt in the evening slot, any slot whatsoever, on that beautiful Monday, one thing is for sure that you are going to experience this particular exam requirement. The examiner will come up with this question that using the information provided, you got to describe 8 audit risks, and then you have to explain auditor's response to each risk in planning the audit. You know what? One of the most important word is one of the most key word is auditor's response. This is very tricky. Don't think like a management. For this particular class, for this particular topic, if you want to have a grip on this topic, if you want to enjoy this topic, if you want to be crystal clear for audit risk, if you want to nail the AA exam for this particular topic and beyond it, you got to think like an auditor. For your exam, FA, FMA, MBA, tax, FR, financial management, performance management, you were part of the management. You were acting as a management. You were acting as a financial controller. You were acting as a manager of the company. But for AA and AAA, you got to think like an auditor. So your response has to be something, an action or a plan of action which an auditor would execute. Think like an auditor. So in this lecture, I will try to convince you that you are an auditor and your writing, your words, your sentences should reflect what an auditor would do or what an auditor would think or what an auditor would like to perform. Now, what about the marking scheme? What about the exam requirement? Well, you got to describe 8 audit risks. For example, now when I say describe 8 audit risks, it means first of all, you have to identify the audit risk and then you got to explain the audit risk. The identification of audit risk will score half mark, and the further explanation, which should start with a brand new sentence, will score another half mark. AA has got 40% pass rate globally. Those 60% unfortunate students will never score extra half mark available for the explanation of audit risk. They will always feel good by only identifying the audit risk. So we are not supposed to commit this mistake. And I will try to highlight in this lecture how we can score full 1 mark. And then we got to come up with the auditor's response. And the greatest agenda or target in my mind right now for this session is to make you realize what is an auditor's response. Think like an auditor. If you have got a doubt, think like an auditor. Your doubt should be the doubt of the auditor. If you're planning an action, think like an auditor. Your action should be the one which an auditor would execute. Don't bother about the company's profitability. Bother about the non-compliance of the accounting standard. Okay, I hope I'm clear up to this point. Yes, you can do that. You can start your explanation in this way. Hold your thoughts, please. Hold your thoughts. Give me some time. As we all know that audit risk has got 2 components. The first component, which is very common in the exam, It's called risk of material misstatement. Now, a tutor such as me could talk about risk of material misstatement for an hour or so. But if you want the gist of the matter, if you want the bottom line, if you want the knockout punch, there is only one phrase: non-compliance of the accounting rule or accounting standard. That's what risk of material misstatement is. So if you want to think about risk of material misstatement, just imagine that the financial statements could be materially misstated. Why the hell financial statements could be materially misstated? It is only because of one possible reason: non-compliance of the relevant accounting standard. That non-compliance could be because of inherent risk or control risk. Let's forget it. We have moved on. That's your bookish knowledge. As of now, think about the relevant accounting standard which could be compromised by the client, which could be breached by the client, and as a result of that, financial statements could be materially misstated. So, how to score half mark? Briefly figure out the story from the question itself, but that will not give you any mark until or unless you will point out which financial statement items are at risk of over or understatement. Once you are done with briefly explaining the question, briefly identifying the story from the question or the issue from the question, you got to end your sentence by highlighting which financial statement items are at risk of under or overstatement. That gives you half mark. Yes, you can use the copy paste technique. But in order to score full mark and in order to ensure that we end up being the successful students, we got to move on to the next paragraph, next line, I would say, not the next paragraph. And I need to explain why, as an auditor, I have got this doubt in my mind that the client's accounting treatment is wrong or could be wrong. Sometimes the accounting treatment performed by the client is actually wrong. For example, I remember there was a question called Darjeeling. In that question, well, let's go to Darjeeling right now. Wait a second. By the way, just for the record, Darjeeling is already available in your portal. Okay, Darjeeling. All of you have got 2 minutes to read the first 6 or 7 lines which I've just highlighted for you. Take your time. There is no rush. Let me tell you, there are two problems. There are two financial statement items which are questionable here. Take your time. You have got 2-3 minutes to read those 7 lines. So those who have actually attended this question, Farah, thank you very much. Test, well done. Well done. Well done, everyone. Well done. Now let me explain what I'm trying to build here. As far as year-end intangible non-current assets are concerned, there is a risk that within the 0.9 million, there is a risk that management might have incorporated research expenditure as well, which does not meet the capitalization criteria, which always needs to be expensed out. Moreover, there is a risk that those amounts which relate to development expenditure, they might not meet the strict criteria in accordance with IS 38 because some of the products are at early stages of their development cycle. So there is a risk that you're not dead sure that the client's accounting treatment is actually wrong. But as a skeptic auditor, you're expressing your risk, you're expressing your doubt. As far as the second issue is concerned, they have purchased a new manufacturing line and the purchase price would be incorporated, installation cost would be incorporated, but the 5-year servicing and maintenance plan costing 0.5 million, it is not allowed to incorporate the 5-year maintenance cost as part of the tangible non-current asset. So this is a breach of IS 16. I will not say there is a risk that non-current assets are overstated. I will say the non-current assets are overstated because IS 16 does not allow this. So guys, have you realized, or please realize how your wording would change? There is a risk that, and this is not correct. This is not in line with I-16. So you have to be smart enough to realize, and you have to maneuver your wording. The examiner wants you to appreciate that IS-16 has been breached, and the examiner wants you to realize that it is your doubt that IS-38 could be breached. Am I clear with this point? Especially in relation to Darjeeling company. By the way, Darjeeling is available in your portal. It's a fantastic question, Darjeeling. Okay, guys, thank you very much. Thank you. Thank you for the input. Now, what about the second audit risk? Well, the AA examiner is very aggressive about the audit risk / detection risk nowadays. If it's a new audit client, for example, I think so, in the centipede or maybe in the heart company. Let's explore heart company. Heart company. So heart company is also available in your portal. This is a new audit client. So new audit client is a supreme example of detection risk. Time pressure. I don't exactly remember the name of the question, but there was a question in which the management requested you to finish off the audit or start the audit as early as possible and finish off the audit as quickly as you can. So if the client is creating some kind of a time pressure for you, there is a possibility that because of time pressure, the auditor would cut the corners, the auditor would unnecessarily reduce the sample size, the auditor would unnecessarily reduce the substantive testing, and as a result of that, the auditor will not be able to detect the material misstatements in the financial statements. Resources, lack of resources, or if there is a doubt over the competence of the auditor, all those factors could create detection risk. One of the most common and highly examinable detection risk is the use of third-party services by the client. Almost in every other second, third question, this is examined by the AA examiner. Let me take you for an example. So again, heart company. Yeah. Heart company's payroll function is outsourced to an external service organization. Puny company. Puny company decided to outsource its payroll function to an external service organization. Puny company maintained its own payroll record until a particular point of time during the year, that is April, at which point the records were transferred. So this data transfer creates a risk of material misstatement, maybe because of the fact that when the data was transferred, it was not completely and accurately transferred. But this outsourcing thing creates detection risk. So there are many questions. Darjeeling is available. Yeah, those parts which are not relevant to audit risk, those last two parts of Darjeeling which are relevant to substantive procedures, I would have skipped those two parts intentionally. We will cover those parts in a live class. Is it okay? No, sir. Audit risk. Are you sure Darjeeling is not fully available in the portal? Okay, I'll look into it. Only ratio explain. Are you sure? Okay, we'll discuss Darjeeling in the next live class. Don't worry. Darjeeling is a fantastic question. We'll explore Darjeeling. Do remind me. Do remind me after a day or two, please. It's on me. I love Darjeeling. I love that tea. Okay, don't worry. Thank you. Okay, so back to the. So this is how we describe audit risk. A, risk of material misstatement. B, detection risk. Now, last part, how are we going to explain the auditor's response? The key to the auditor's response is it has to be an auditor's response. The response must be the response of the auditor. Don't think like the client, think like an auditor. Your response should be in line with the risk. So if the risk has got to do with the recoverability of receivable, your response should be about the recoverability of the receivable. So if there is a risk that the year-end receivables could be overstated because of the possibility of bad debts, then your response should be, you got to look for the post year-end bank statement and cash day book in order to confirm whether the receivables have converted into cash or not. Because the post year-end bank statement and cash day book will confirm whether those receivables have now been converted into cash or not. So think like an auditor. Are we clear? Now the
Sir,
last,
can you repeat? Can you repeat?
yeah,
Last few
I
sentences.
can. The the response should be the one which an auditor would execute. The response should be a plan of action which an auditor would come up with. So think like an auditor. So if, for example, the year-end receivables are at risk of overstatement, maybe because of the fact that the client has given extended credit terms to its customers. So yeah, that creates a doubt over the recoverability of the receivables. Now, if a student is going to, or if an auditor is going to cast the receivables, if a student is going to add them up to confirm the arithmetical accuracy, it's not a good response, because as of now, we are not unsure whether the mathematical accuracy is correct or not. We are unsure whether the receivables will be converted into cash or not. So the correct response has to be in line with the audit risk. For example, you got to extend the post year end, year after the year end, post year end cash receipt testing. And how would you do that? Inspect the post year end bank statement and cash day book. So if the year end is 31st March, look for the April, May bank statement and cash day book. Why? In order to confirm whether those year end receivables have now been converted into cash or not. Because if they did, it means those year end receivables were not overstated. So, what I'm trying to say is that your response should be an auditor's response. You got to think like an auditor. A very interesting example: if there is a doubt over the year end inventory's value because of the fact that that inventory is obsolete or damaged, a poor answer would say management or the company should discount the products so in order to sell off the products. You are thinking like a company, you are thinking like a management, you are thinking what a company would do. Think like an auditor. You have got doubts over the NRV of the inventory. You have got doubts whether the inventory is overstated at the year end, because according to IS2, inventory has to be valued at lower of cost NRV. Now, what about your response? Look for the post year end invoices in order to confirm, whether the inventory which was sold after the year end, which belongs to the year end, which was sold after the year end, whether the NRV was over and above the cost or not. Because if it was over and above the cost, it means inventory was not impaired. And if it was sold, if the NRV was below the cost, it means the inventory needs to be written off. So the response has to be in line with the risk. Now, before I move on to my second part of the today's very important and enlightening lecture, one thing is for sure, all of us are going to experience audit risk question in the exam on Monday. But there are two possible shapes. For example, heart. For example, Darjeeling. Now, what is the difference between heart and Darjeeling? Well, in heart, there is scenario only. Venus, aquamarine, blackberry, scenario only. But if the examiner is going to incorporate extract of financial statements, but I truly believe that makes the question a lot more easier. You have got Red Smith, you have got Darjeeling, you have got Centipede for such type of questions. So the exam requirement will be same, but ratios will make your job a lot more easier. That's what I truly believe. Can we check the sale notes because it might be possible that the company overstated the receivables? No, no. Why? Because I don't have doubts over the fake receivables, over the existence of the receivables. As of now, I believe the receivables are for real. But because of the extended credit period, because of the fact that the client's customers are facing cash flow problems, I've got doubts over the recoverability of the receivable. Am I clear? Are you clear? Have you realized the difference? Yeah. I will be interested in the sales invoice to confirm whether the receivable is a genuine one or a fake one when I've got doubt whether the receivables are real or fake. But as we, according to my example, which I created, I don't have doubts over the existence of receivables. Yes, I truly believe the sales were made. I truly believe those receivables do exist. But I've got doubts whether the receivables will be converted into cash or not. So it's about the valuation. Am I clear now? So if you have got doubts over the recoverability of the receivable, the sale invoice will not help you. Yes, if the receivable has now been converted into cash, yes, the bank statement and cash day book, post year end bank statement and cash day book, that will help you. Am I clear now? Oh, thank you. Please explain again. Are you clear now? Okay, guys, hold on to your seats. We are moving towards the second part of the today's lecture. So that was the first part. So you are saying that if it cash, it's bank statement that will help. What I'm trying to say is that, okay, let me try once more. Assume you are my audit client. I'm the auditor, you are my audit client. At the year end, you have got receivables of $1 million. Now, I don't have doubt whether those 1 million are fake or real. I'm dead sure that those receivables of 1 million are real. So if I'm going to look into the sales invoice, that will not confirm whether the receivable will eventually be converted into cash or not. The doubt is the receivables are overstated. The doubt is the receivables are overstated because the receivables will not be converted into cash because of the possible bad debts. So what I'm saying is that if after the year end, those 1 million are converted into cash after the year end, and who's going to tell me whether those are converted into cash or not? The post year end bank statement or cash day book. Because if the customers are going to pay, it will be reflected in the bank statement, it will be reflected in the cash day book. So the cash day book and the bank statement, post year end bank statement and cash day book will confirm whether the receivables were overstated or the receivables were not overstated. Am I clear? Finally, clear now. And that makes my day. Okay. Okay, Ukil, thank you. Okay, I'll answer the bookish knowledge part at the end of the lecture. As of now, I'm totally into the audit risk. Okay, this is your study text, your book, Kaplan book, and this is Kaplan book, chapter number 5. Yeah, chapter number 5. The name of the chapter is Risk, Audit Risk, Exam Focused Audit Risk question. Audit risk is regularly examined. Yes, I'm dead sure about it. And it is important to answer the question from an auditor's perspective rather than the perspective of the client. And this is the biggest takeaway of today's lecture. This is the most important learning outcome of the today's lecture. If one could absorb and if one could understand this sentence, I'm dead sure you will not fail the risk question. I'm dead sure about it. The auditor is trying to detect the material misstatements in the financial statement. Why? Is there anyone who could tell me why we are trying to detect material misstatements in the financial statements? Because if the financial statements are materially misstated, and if I'm not going to detect that, I would face audit risk. My auditor's opinion or my opinion would be wrong. The auditor is not looking to identify risks which affect the profitability of the company. I'm not bothered about the company's profitability. I'm bothered about the breach of the relevant accounting rule or standard. The most common mistake that candidates make in exams, and we are not going to do it. A common mistake that candidates make in exams is to explain business risk rather than audit risk. Don't think about the company. Don't think about the company's profitability. Don't think about giving a suggestion which could improve the company's profitability. No, think like an auditor. Think about the relevant accounting rule or standard. Think about the possibility of material misstatement. Let's explore a few examples, and I'm sure it will make you more clear for the audit risk. Now, imagine you were attempting your AA exam on Monday and you read in the question or you identified a risk in the question or out of the question that the customers are struggling to pay their debts to my audit client called Darjeeling Company. As a result of that, receivables would be overstated. Yeah. Now, what about the correct explanation? The correct explanation is considering receivables may be overstated if the debts are not recoverable and the management might not wish to write them off as an expense. There is a risk that management would try to manipulate, management would try to hide the fact that they need to charge the relevant amounts in the profit and loss account as an expense. That's the correct response. That's the correct explanation. An incorrect explanation would be the one where you are not thinking about the breach of the accounting rule or standard. What's the correct accounting rule? It needs to be written off. Incorrect answer is recoverable debts may shoot up, may increase, and as a result of that, the company's profitability would be compromised. Why are you bothered about the company's profitability? You're not thinking like an auditor. Maybe you're thinking like a business consultant or maybe the management. Example 2. Your audit client operates in a fast-paced industry, and as a result of that, inventory could be overstated. Why? Because according to IS2, inventory should be valued at lower of cost or NRV, and maybe because of obsolescence, the year-end inventory's NRV could be below the cost. That's a correct explanation. You are bothered about IS2. You are bothered about the breach of IS2. What about incorrect explanation? Inventory may have to be written off, and this will reduce the company's profitability. That's an incorrect answer. Another incorrect answer. That's an incorrect answer. Another incorrect answer, which is you're thinking like a company. You should not be bothered about the company's profitability. Last example. So there is a recession going on. There is an economic crisis which the company is facing. The company is also predicting negative cash flow forecast for the next 12 months. All those factors could mean that the company might not be able to survive and they are facing going concern difficulties which needs to be adequately disclosed. There is a risk that that disclosure is either inadequate or maybe the client has not made the disclosure at all. Again, it's a breach of an accounting rule. An incorrect answer would be falling revenue will reduce the profitability of the company and the company will not be able to survive. It is something which the company will be thinking. So again, you got to realize, you got to think like an auditor. Now, what about auditor's response? As I've already mentioned, yeah, any question from anyone?
Sir, I have a question. Sir,
Yeah,
is it
please.
necessary to disclose, to have a disclosure by a company? Like the last example you gave, that there is a recession going on in the economy. So is it necessary for a company to disclose their going concern status?
I am a shareholder of a company. You are an existing loan provider of a company. Wikil is the potential loan provider of the company. Jamila is the supplier of the company. So all the stakeholders have got this fundamental right to know. It's our right to know what's going on and what are the future prospects of the company. So the company's board of directors or the management are obliged to disclose, adequately disclose, if there is an uncertainty related to going concern. Please watch out my words. I'm not saying that the company is not going concern. Even if the company is a going concern company, but there is an uncertainty related to going concern, it has to be adequately disclosed by the management. Now let's think like an auditor. There is a risk that the management might wish to hide all that because that could affect the share price, right? That could affect the loan negotiations, right? That could affect the supplier contract, right? So the management has got an incentive. They would try to hide all that. So as an auditor, I've got this apprehension in my mind. I've got this doubt that there is a risk that A, the disclosure is not made, or B, the disclosure is there, but it's not adequate. So yes, the management is obliged to disclose that, but they are not going to do it every time. So think like an auditor. There is a risk that. Are we clear? Thank you very much. Now let's explore how to differentiate between a relevant response and an irrelevant response. Mind you, irrelevant response will score 0 mark. It is so convenient for a student to come out of the examination and he or she will share or express how did the exam go, and the student will say, yeah, you know what, I was not prepared, I was not well prepared for the double A, but you know what, I attempted all the paper, it went great, I'm super confident about it. So if a student is going to let me know that he or she was not prepared, he or she did not attempt the mock exam, he or she did not understood things, he or she did not practice the questions on the practice platform, still eighth wonder of the world, apart from Eiffel Tower, Taj Mahal, and the other wonders, eighth wonder, your exam went as smooth as silk. Well, I'm not going to say it on your face, but unfortunately, with my 13, 14 years of experience, you're not going to make it. It's so easy to write rubbish in double A and triple A. These are discussion based papers. One would have positive vibes because he or she has expressed so much, but all that could go in vain because your response would score 0 mark if it is not a relevant one. So let me explain. It's not the case in tax or FR exam because if you know, you will be able to calculate, otherwise you will not be able to. So a tax or an FR student or a PM or FM student will not say, you know what, I was not well prepared, but I attempted all the paper and it went very good. No, that's what not. This is not the case in FR, tax, or PM or FM exam. But in double A, the examiner asks you about Messi. The examiner asks you about Messi, the living legend, the greatest football player ever born, and you were writing about, well, maybe you were writing about Cristiano Ronaldo. So maybe your response was not appropriate and that will not score any mark. Anyways, so what about audit risk? Uh, let's recall customers are struggling to pay debt. Receivables may be overstated, maybe because of the fact that management does not wish to write them off. Management wants to, manipulate. Now the relevant response. Inspect after date cash receipts. What do I mean by after date? after the reporting date, after the statement of financial position date. Why? Why would you inspect after date cash receipt? Because I just want to know whether those receivables have now been converted into cash or not. That's a relevant response. In fact, another relevant response could be, you just need one for one mark, but another relevant response could be, okay, get the age receivable listing from the management, try to identify the old debt which may not be recoverable, and then have a discussion with the management that there is a need to write them off or create an allowance against them. Those two responses are relevant to the risk. They are about the irrecoverability of debts. It's correct. Now, what about an irrelevant response? Example one, irrelevant response. Example one, I will get the breakdown of all the receivables from the year-end receivables. I will add them. 4,000 plus 2,000, 6,000, 6,000 plus 3,000, 9,000, 9,000 plus 9,000, 18,000, 18,000 plus 4,000, 22,000. If you are going to cast them, if you are going to add them up, what did you achieve? Nothing. You have ensured the arithmetical accuracy. This was never questionable at this point of time. So it's an irrelevant response. Another example of irrelevant response could be obtain external confirmation from customers. Contact all the receivables. Have Are you supposed to pay my client 4,000? Are you supposed to pay my customer 2,000? Are you supposed to pay my client 3,000? They will say yes, yes, yes. But are you dead sure they are going to pay? What about the recoverability of the receivable? They will say, yeah, we are obliged to pay, but are you sure they are going to pay? So that response is not a correct response. That response will confirm whether those receivables are fake or real, but that response will not confirm whether the receivables will be converted into cash or not. So it is so easy to write an irrelevant response. A pathetic response could be, which will ensure failure. The company should improve credit control procedure. The company should chase the debtors. The company should offer early settlement discounts in order to collect cash. You are thinking like a company or not thinking like an auditor. Am I clear? What is the difference between a relevant response and an irrelevant response? Think like an auditor. Can I have some kind of yes for the sake of my motivation? Thank you very much. Well done. Thank you, Farah, Vikil, Shireen, everyone, Joseph. Thank you very much. Let's explore another example. The client operates in a fast-paced inventory industry. In, According to IS2, inventory should be valued at lower of cost or NRV. There is a risk that the year-end inventory could be overstated. Why? Because of the obsolescence, there is a possibility that the potential NRV is below the cost. Am I clear with all this? We had a discussion on that. Now, what about the correct response? As an auditor, I will obtain the aged inventory listing and I will try to figure out the old items. And then I will discuss with the management that these are so old, you guys are unable to get rid of this inventory. It's obsolete. The NRV is surely below the cost. Guys, you need to write them off. That's a correct response. You're thinking and acting like an auditor. Poor response. Poor response. Now, I'm not thinking like an auditor. The company should discount the inventory in order to get rid of the inventory. This is what the management has to think. This is what the management would decide. This is something which the management would execute. The company should discount the inventory in order to sell it. This is an incorrect response, irrelevant response, and that will not score a mark. This response, the company should discount the inventory in order to sell it. This is a client response. This is the company's plan of action, not the auditor's response. Are we clear? Can I have confirmation on that? Thank you. So this was from your study text. There are few other points which I am leaving for your effort. In fact, this test your understanding one is a beautiful question which will make you more confident on audit risk. But as of now, I am moving towards the third and the final part of the today's lecture. And the third and the final part is about puny company. Yes, I will share not only the study text, but the exam kit, the planner document, everything all over again. Don't worry. Just send me a text in the WhatsApp group after the class. Don't do it right now. Okay, puny company, part A. What about part A? Is there anyone who truly believes that he or she could score 4 out of 4 over here? This part A is what I call straightforward bookish knowledge. Trust me, if you are good at OTQs and if you are good at straightforward bookish knowledge, you have already nailed the paper, nailed the exam. Let me give you an example. Let me give you an example with the help of heart. Okay. Now imagine I scored 24 out of 30 in section A. You can have an argument in your mind that Mr. Ahmed is exaggerating by saying 24 out of 30. But trust me on that, 24 out of 30 is not an exaggerated number. Trust me. That reminds me of a song of Imagine Dragons. Trust me, darling. 24 out of 30 is not an exaggerated number. There is a condition. Don't solve all the OTQs at the end of the session. Solve OTQs more or less on a daily basis. Make sure you solve OTQs from both exam kits. Make sure you read the solution. Almost entire Kaplan kit is available in your portal. I'm talking about the OTQs. So the section A questions are going to be the real critical success factor. As a student, you should be absolutely crystal clear why option A is not correct. You should be that clear that you could explain to someone why option B is not correct, why option C is correct, what changes could have been made, and that could have transformed option B as a correct option. If it is now an incorrect option, what changes could have been made in order to make sure D is a correct option? If you are that clear about each and every option, you are going to score 24 out of 30 or more than that. There are two major resources, Kaplan exam kit, DPP exam kit, and at the end of the session, I will provide you very important questions as well. Questions out of the exam past papers, few selective questions. If you are going to solve OTQs from both kits, you will ace the exam. So imagine you score 24 out of 30, 35 to 40 minutes are gone. Now you are moving towards your section B. Once you started your section B, let's assume you have got heart, a full 30-mark question on risk in front of you. Okay. What about part A? Explain the benefits of audit planning. It's a straightforward bookish knowledge. The benefits of audit planning are very obvious. It will ensure that we will be able to identify the potential risk of material misstatement as quickly as it could be. With this audit planning will ensure we devote more time and resources to critical areas. This audit planning will ensure we will be able to meet the deadlines. This audit planning will ensure we will ensure that the overall audit is cost effective for the audit firm. After all, we are a profit seeking organization. So the benefits of audit planning is a straightforward bookish knowledge. We have discussed this thing in the lectures. Okay, what about part B? 8 risk and 8 auditors response. All over the world, the tutors and the students are running after the part B. I will make sure you will master part B. You don't have to worry about part B. Let's ignore part B for now. Part C is about substantive procedure. Substantive procedure is my third major topic. So let's ignore part B, part C as of now. What about part D? Explain the safeguards which the audit firm should implement to ensure that the conflict of interest is appropriately managed. Your study text, chapter number 4, ethics and acceptance. And this is what we called an ethical issue, conflict of interest. So if you are already auditing McDonald's, KFC might approach you for audit. This situation is going to create a unique ethical issue for the auditor, and we call it conflict of interest. So this is a straightforward bookish knowledge question. You have to make sure that first of all, you need to inform both the clients about this unique situation, and you need to get the consent from both the clients. You have to make sure you have got two separate engagement teams with two separate engagement partners. There has to be physical separation. You have to provide loads and loads of training to both the audit teams. You have to make sure that your both audit teams will sign the confidentiality agreement. You have to ensure that at the end of both the audits, you will come up with quality review just to make sure you have not made any compromise whatsoever. Guys, this conflict of interest creates doubt over two fundamental principles of ACCA's Code of Ethics and Conduct. A, confidentiality. B, objectivity. You might be in favor of KFC. Automatically, you are against McDonald's. You might slip an information or two to McDonald's relevant to KFC. So it's about confidentiality and objectivity. What is part D? It's a straightforward bookish knowledge. Now imagine my double A student would score 5 out of 5 in part D, 4 out of 4 in part A. I'm not bothered about part B and C. Trust me, it's a promise. Part B and C is going to be a walk in the park for the entire double A student. All the tutors and students are running after part B and C. But if you are going to make sure you scored what? 24, 24 out of 30 in section A. And just imagine you have just scored another 9 out of 9 in the straightforward bookish knowledge. You are somewhere around 34. Well, definitely there will be more parts of bookish knowledge in the CRQ number 2 or 3. So my philosophy is, let me summarize my philosophy. So if we are going to score what? If we are going to score 24 out of 30 in section A, and for example, 15 out of 15 in the straightforward bookish knowledge. 15 is an average score when it comes to straightforward bookish knowledge. You have scored 39. And how much paper you have attempted so far? 45. How much you need more? How much you need more? You need to score 11. Who's asking you to run after the distinction? If you are going to score distinction, if you are going to be national place winner, I will be the third or maybe the fourth most happiest person on the planet Earth. Well, why fourth? Well, I'm assuming you will be the first one. Your parents are going to be the second or third. So I'm going to be the fourth one. Please try to understand. If we just need 11. Now, how many paper is left? 55. Is it mission impossible? Are you Tom Cruise? Are you Tom Cruise? And is this mission impossible 11 out of 55? How does that sound? The last 10 minutes are the most important 10 minutes maybe of the entire session. If you could realize this is an eye opener. This is how I believe AA is the most easiest exam among the skill level papers. You just have to make sure your exam preparation covers 3 different angles. A, OTQs. B, straightforward bookish knowledge. As far as risk controls, procedures, CRQs, or application side is concerned, that's my job. Leave it on me. Is this clear? Even if you realize, or even if you believe that the numbers which I've just expressed are overstated, okay, let's make it 22 out of 30. Let's call it 12 out of 15 in the bookish knowledge. Even that's a decent score. 12 plus 22, 34 out of 45. Now you need what? 16 out of 55. Is it doable? Is it more realistic now? Can we pursue this plan now? 22 out of 30, 12 out of 15. Guys, what about this? Are you motivated enough to make sure from now onwards your exam preparation has got 3 different perspectives? Thank you very much. If it is the case, all that energy and all that effort is in the right direction. Okay, let's quickly explore the last part of the today's lecture, and this is about. Thank you very much. Most welcome. Most welcome. So the last part of this lecture is about uni company. By the way, there are many questions available in your portal. For example, Hart, Harlem, I believe Darjeeling. Otherwise, I'll cover Darjeeling, Aquamarine, Venus, Red Smith, Sycamore, Blackberry. Blackberry is one of my all-time favorite. Maybe Centipede. Yeah, Centipede. But this puny is not available in your portal. So please concentrate. Part A is straightforward bookish knowledge. Let's forget about it. What about part B? We need 8 audit risk and we need 8 auditors response. Okay, no problems with that. All of you have got 1 minute to please read the first paragraph and I will consider it as my break. You have got 1 minute. Okay, guys, it is 1st July 20x5. For an audit risk question, it is always going to be the same case. Who are you? You are an audit supervisor. When it comes to AAA exam, you are going to be an audit manager soon, sooner than soon. The audit firm is called Daffodil Company, and you guys are planning the audit of Puny Company, who has got a year end after 3 months. So the year end is after the 3 months. You have started it early. Why? Because this is the planning stage. So we need to start early. The year end is 30th September. That company is a food retailer. And this company has got a large network of stores across the country and 4 warehouses. Okay, that's important, 4 warehouses. The company has been a client of your firm for several years. So the new audit client detection risk is not available in this question. I'm so sad. The forecasted profit is 28.9 million. The audit manager has attended a planning meeting with the finance director, and the manager has provided you, the audit supervisor, with the following note. Okay, let's start the question. P company has an internal audit department which undertakes controls testing across the network of stores. Okay, they've got an internal audit department. Each store is visited at least once every 18 months. Okay, the audit manager has discussed with the finance director. Audit manager, my boss, my superior, my senior, has discussed with the finance director that the external audit team, yes, we the external auditors, may rely on the control testing which is undertaken by internal auditor. It's not prohibited to rely on the work of the internal auditor, but what if the work performed by the internal auditors are not executed, are not well planned and well executed? So if we as an external auditors are going to place reliance on the work of the internal auditor without evaluating the fact that what if the work performed by the internal auditor is not critically planned, not well executed, there is a risk that we might be relying on an inferior quality of work And as a result of that, we will not be able to gather sufficient appropriate evidence. We will be relying on, we are unnecessarily relying. There is a risk that the work performed by internal auditor is not of sufficient quality, and we are not being critical about it at all. So this is a unique example of detection risk. As an auditor, once I am going to place reliance on the work of the internal auditor, I'm not testing their work. I'm not evaluating their work. I'm not even, considering any sample out of their work. I will not be able to gather sufficient appropriate audit evidence. And that's what the detection risk says. Auditor might not be able to, you know, detect the material misstatement. Why the auditor will not be able to detect? Because the auditor is not being skeptic enough. Auditor is relying without any justification, without being critical about it. What should be the auditor's response? Well, ideally speaking, we need to have a meeting and a discussion with the internal auditors. We need to review their planning documents. We need to review how efficiently and how effectively in line with the plan they executed their work. Maybe on a sample basis, we need to review their work as well before considering to place any reliance on the work. So this is a very challenging and a very different detection risk. I've requested this many a times. Create a separate file which incorporates all the detection risk along with the responses. There are 5 to 6 examples of detection risk, and all those detection risks are extremely important, and you are going to get at least 1 or maybe 2 in your final exam. Well, there are questions in the chat box. Let me finish this, then I'll come back to the questions. Okay, let's continue. So if you have attended my lecture on Red Smith, on Darjeeling, on Centipede, and many other questions which have got a flavor of ratios and trends, you will find it a very easier one. This is going to be an old audit risk for you. When I say old means something which is repetitive in every other question, in every second question. During the meeting, the finance director provided some forecast financial information. Revenue for the year is expected to increase by 3%. Gross profit margin is expected to increase from 56 to 60%. So revenue is increasing, gross profit margin is increasing. Okay, that seems okay. And the operating margin is predicted to decrease from 21 to 18%. Now that's unusual. If the gross profit margin is going to increase, why? Well, that's unusual. Why the operating profit margin is predicted to decrease? There is a risk that the management might have incorrectly classified the expenses. Some of the expenses which should have been, that's my apprehension, that's my risk, that's my doubt. Some of the expenses which should have been classified as cost of sales have been incorrectly classified as operating expenses. And as a result of that, gross profit margin has boosted, but the operating profit margin has gone down. So this is a very, very repetitive audit risk. It's a risk of material misstatement in relation to the misclassification of expenses. Am I clear? What about the auditor's response? Well, you need to get the breakdown of the cost of sales. Look for an item which should have been there, but it's not. Maybe you need to compare this year's the breakdown of this year's cost of sale with the last year in order to figure out which particular item is missing now. Okay, we are done with 2 risks. And by the way, the first risk was a very new one, very different one of its kind. But this second risk is a very repetitive one. So I'm sure you're already familiar with it. Key company values inventory in line with industry practice, which is to use selling price less average profit margin. The directors consider this to be a close approximation to cost. Well, guys, in accordance with IS2, inventory should be valued at lower of cost NRV. And in accordance with IS2, this practice of selling price less average profit is acceptable if it is the industry practice. IS2 allows it. But being a skeptic auditor, I've got doubt. There is a risk that the amount which they are determining by calculating or by deducting the average profit from the selling price, maybe it is not a close approximation to the cost. And as a result of that, the inventory could be misstated. What should be the response? Well, I need to get the breakdown of the cost per unit. I need to make sure that it is close approximation or it is actually in line with the management calculation of selling price less average profit. Because I've got doubt, maybe this is not correct. So that's the third risk. The company does not undertake a full year end inventory count and instead undertakes monthly perpetual inventory counts, each of which covers 1/12 of all lines in stores and the warehouses. Okay. What about perpetual inventory counts? It's it's like a real time system. A perpetual inventory system is a real is kind of an online system. It's whenever an inventory will will be added on, or it will be going out of the company or the or the company system, it will be recorded immediately. So the perpetual inventory count means they are going to count one item in January, one item, another item in maybe in Feb, another item in March, and the story goes on. There is a risk that all the items will not be covered within the accounting period, and as a result of that, that particular item could have a discrepancy. The year end inventory, the physical inventory and the inventory records could have could have unreconciled items, and as a result of that, the year end inventory could be materially misstated. Okay, as part of the interim audit which was completed in May, an audit junior attended a perpetual inventory count at one of the warehouse and noted that there were a large number of exceptions where the inventory records show a higher quantity than the physical inventory which was present in the warehouse. When discussing these exceptions, the financial controller told the audit junior that this is a recurring issue. So the inventory records is showing, for example, 100 units, but physically there are 70 units. So there is a discrepancy. Large number of exceptions where higher quantity of inventory in the records than the physical inventory. So there is a risk that the balancing figure has been stolen. That's why it's not there. Maybe it was damaged and somebody threw it away. So as a result of that, the necessary adjustments are not performed. There is a risk that the year-end inventory would be overstated because the management might be relying on the numbers which are available from the inventory records rather than the physical inventory. So considering the physical inventory is on the lower side, the year-end inventory would be overstated. Okay, so we are done with 4 risks so far. The first one was about the detection risk. The second was about the misclassification of expenses. Third one was about the fact that inventory could be overstated because maybe that was not an approximate. That is not an approximation of cost. Fourth one was about the fact, what if a particular line of inventory or line of store is not part of the inventory count. Fifth one was about the fact that there is a discrepancy between the physical inventory and the inventory count. So we are done with 5. Okay, let's continue. Now, easier audit risk will jump in. During the year, internal audit performed a review of the non-current assets physically present in around 1/3 of the company stores. A number of assets which had not been fully depreciated were identified as obsolete by this review. This is a key sentence. Please read that sentence all over again. Number of tangible non-current assets which have not been fully depreciated. So they've got a carrying value. But as a matter of fact, they are obsolete. So they've got a carrying value, but their recoverable amount is nothing whatsoever. Fair value less cost to sell is nothing. Value in use is nothing. They are obsolete. So according to IAS 36 impairment, if the carrying value is greater than the recoverable amount, the balancing figure needs to be charged in the profit and loss account as an expense. So the year-end non-current assets would be overstated. Why? Because the non-current assets are overstated because they are not fully depreciated, but they are obsolete. Moreover, this also reflects that the management's estimate for the useful life and the depreciation expense is not correct either. Because if they are not fully depreciated, but they are obsolete, it indicates that the depreciation expenses for the assets are understated. The estimates regarding the useful life is not correct. We need to review. What should be the auditor's response? We need to have discussion with the management that they need to write those non-current assets off in the profit and loss account immediately, considering they are obsolete. And we need to have a discussion with the directors regarding the useful lives, regarding the depreciation policy and the depreciation expense. And we need to understand why the depreciation is understated. We need to have a discussion with them. The company launched a significant TV advertising campaign in May 20X5 in order to increase the revenue. Okay, they spent certain amount. The directors have indicated that at the year end, a current asset of 0.7 million will be recognized, as they believe that the advertisement will help to boost the future sales in the next 12 months. The last advertisement will be shown in September 20X5. Considering you are spending 0.7 million in May, the advertisements will end up during the year, that is in September. Mind you, the year end is September. You cannot recognize it as an asset. You will get benefits out of this as advertisement for a year or two maybe, but you have expensed it out. You have invested that, you have spent that money on advertising. This is a revenue expenditure which needs to be charged in the profit and loss account for this period. So at the year end, your assets and your profit both are overstated. Why your asset is overstated? Because you have recognized it as a current asset. Why your profit is overstated? Because you should have charged the 0.7 million as an expense. What should be the auditor's response? Well, we need to review and we need to have a discussion with the management regarding the accounting treatment of 0.7 million, and we need to make them understand that they need to write it off. We need to understand what's the rationale, what's the reason behind the recognition of this as an asset. During the year, the company decides to outsource its payroll function to an external service organization. And if the payroll, because I will not be able to detect the material misstatements, because challenging for me to get the evidence from that of the payroll cycle, and sends monthly reports to the puny company which detail wages, salaries. Okay. What should be the response? Well, I need to consider the amount and the material of that. Consider contacting the auditor of that third party, and I will try to get the type 1 and type 2 report from the service organization's auditor. Type 1 report is a report where I will ask the auditor of the service organization to let me know what controls they have in place for the payroll, what controls the third party has in place. And in the type 2 report, I will be looking forward what controls are in place and how effectively those controls are operating. So this is an example of detection risk. Make sure this is part of your separate notes because it's a very repetitive one. Puny company maintained its own payroll until 30th April, at which point the records were transferred. There is a risk that once the records were transferred, the transferring process was not that well controlled, and as a result of that, the data which was transferred might not be complete and accurate. The completeness and accuracy of the data which was transferred, this creates a risk of material misstatement when it comes to payroll. These two are very repetitive audit risks. P company is planning to expand the company by opening 3 new stores during November, and in order to finance this, in July 20X5, the company obtained a 3 million bank loan. 3 million bank loan, and this loan will be repayable in arrears over 5 years in quarterly installments. Hold on. These 3 lines would create 2 different audit risks, and they are very, very, very examinable. First audit risk, there is a risk that the client has not correctly split the loan among the current and non-current liability, and as a result of that, financial statements would be materially misstated. That's a risk. Moreover, maybe they have not appropriately or adequately disclosed the details regarding the loan. So that's the first risk. Second risk, that additional loan would create an additional finance cost. There is a risk that management has not correctly calculated the finance cost and they have not correctly charged the finance cost in the profit or loss account. And as a result of that, profit could be overstated. So another two risks which are very repetitive. Every other audit risk question would have this story, and there are two risks. Every other audit risk question would have this story, outsourcing and the transferring of data, and that these are another two risks. Four very repetitive risks. Every other question will have an element of provision. Let's read the last part of the question. In preparation for the expansion, the company is looking to streamline operations in the warehouse and is planning to make approximately 60 employees redundant after the year end. No decision has been made as to when this will be announced, but it is likely to be in September, that is before the year end. Mind you, the year end is September. According to IAS 37, provision, contingent liabilities, and contingent assets, if the announcement in relation to the redundancy, if the announcement to the employees is going to be made within the year end provision for the redundancy payment has to be recognized. There is a risk that the management would make the announcement before the year end, that is likely to be in September, but the management will not wish to recognize the associated provision. They will like to understate their liabilities. There is a risk that the provisions are understated, or even if the provision is not there, maybe the provision is not required, maybe the outflow of the amount is not probable, it's possible, still a contingent liability has to be disclosed, right? So this provision thing is a very, very common risk. Now, my dear students, if you have already covered so many audit risk questions, you required 8 audit risks. Provision is an old risk for me. Bank loan, the split of current and non-current liability and the disclosure, old risk. 2. Finance cost, 3. That's an old risk. Detection risk because of the outsourcing, 4. Data transfer, completeness and accuracy. These 5 risks are absolutely old, and my AA student will have no trouble whatsoever, at least in these 5 audit risks. In fact, there is 6th risk as well, which is a very, very old risk. Many questions have this flavor, which is about the misclassification of expenses. So you were required 8 audit risks, and out of 8 audit risks, at least 6 risks are so simple, so repetitive that you would have mastered these 6 in multiple questions. In fact, the 7th risk, which is about the fact that they have recognized 0.7 million as an asset, it is so convenient. They should have charged it in the profit and loss account. Damn it. So am I crystal clear? Can you have confirmation on this one that the 6 audit risks out of the 8 are repetitive, old, not a new, not the troubles, not the complicated one? Can I have yes on that? Okay, yes. Okay, let's go to the chat box. Okay. Randomly speaking, Farah has asked, sir, have you discussed advertisement campaign? Okay. Can you please repeat it? Management has spent 0.7 million during the year. And that 0.7 million has been spent on an advertising campaign. That advertising campaign will start somewhere at the end of the year, somewhere around the year end in May, or somewhere during the year in May, and the advertising campaign will end in September, and the year end is the 30th September. So you need to charge the full 0.7 million as an expense, but they recognize it as a current asset. So at the year end, their current assets are overstated by the 0.7 million, and the profit is overstated by the same amount because this should have been charged as an expense. Am I clear? Farah? Okay, I will come back to gross. Jamila, Farah, are you clear? Okay, Farah is clear. Okay. Jamila is saying, can you please explain gross profit margin risk? There has to be an element of, the gross profit margin and the operating profit margin should complement each other. That's what a normal company would have. So if the gross profit margin has gone up, but the operating profit margin has gone down, I'm not dead sure, but most likely there is a risk of misclassification of expenses. So if certain amount is omitted from the cost of sale and incorporated within the operating expenses, this will boost your gross profit margin unnecessarily, but that will depress your operating profit margin. The overall profit might remain same, but this is not correct because the expenses are misclassified, and as a result of that, the profitability indicator such as gross profit margin and operating profit margin are misleading as well. It's a material misstatement, or at least a risk of material misstatement. What is the first detection risk? The first detection risk. Okay, let me go to the solution for that. Meanwhile, if you've got any question, please use the chat box. Okay, what is the first detection risk in the question? External audit team is planning to place reliance on the work performed by the internal auditor. That is copied from the question itself. What if the work performed by the internal auditor is not that great? What if and considering we are going to place reliance on their work, what if their work is not properly performed? And we are going to place reliance on that. Whatever conclusion we are going to draw, whatever we are going to assume, whatever we are going to, whatever conclusion we are going to draw, all that will be inappropriate. This could result in them performing insufficient level of substantive testing. Why insufficient level of substantive testing? Because as an external auditor, I'm placing reliance on the work of the internal auditor, which should not have been the case because I'm not dead sure whether the work performed by the internal auditor was great or not. So that will increase detection risk, because if you are incorrectly or unnecessarily rely on the work of the internal auditor, and if that work is not okay, if that work is not good, you will not be able to detect material misstatement, and that's what detection risk. What you should have done, or what you should do now as an external audit team, we should meet with the internal audit department. We should read their reports. We should review their files. We should try to understand what was the quality of work, whether the work was sufficiently good enough so that we could place reliance on the work, on their work or not. Are we clear? Any other question? Don't give such headings. The movement in gross profit margin is significant and inconsistent with the fall in operating margin. The gross profit margin has gone up, but the operating profit margin has gone down. There is a risk that, I'm not that sure, there is a risk that the cost may have been omitted. Maybe certain amount have been omitted from the cost of sale, or maybe certain amount have been incorporated as an operating expense rather than cost of sale. And as a result of that, operating profit margin has been boosted, but gross profit margin has been boosted and the operating profit margin has gone down. This is the example of misclassification of expenses. What should be the response? We need to make a comparison of both the cost of sales and the operating expenses in relation to the last year. Compare it with the prior year and try to figure it out if there is any inconsistency. If there is anything which was not there in the last year but it is there, or which was there in the last year but it's not anymore, so investigate it. Jamila is clear? Yeah, clear. Any other question which I've missed out? There a small question. If we master the knowledge based question very well, can we proceed by answering part A, then go to part D, and then come back to part B, or it has to be in order? Okay, Vikil. For double A, you can do that. How? Because for every individual exam requirement, there is a separate place, there is a separate, position to answer the question. But for triple A, there is only a blank workspace and you have to create A, B, C, D by yourself. So your idea is well appreciated for double A, but not for triple A. Any other question? Claire, sir, can you please repeat about heading? Okay, okay, noted, sir. Thanks. May I ask, we have to write heading in each audit risk? No. Okay. Meanwhile, practice platform is opening up. These headings are not required. Misclassification of expense, no, not required. Reliance on internal audit, not required. Inventory valuation, not required. This has got no mark whatsoever. Examiner report has never suggested that you need to come up with such headings. If you're wondering why these headings are there, A, I don't know. B, maybe just to facilitate the understanding, but it has got nothing to do with marks. So don't do that. So let's go to the practice platform. Triple A, yeah, double A, double A. Okay, let's go to double A specimen exam, resume. Okay, what about the bookish knowledge? What was the question regarding the bookish knowledge? Uh, can you please elaborate your question? What about bookish knowledge? Swati, what's your question? Okay, let me go to the navigator. I'm directly jumping towards the section B, question 16. Okay, now Vikil, explain the audit risk and the components of audit risk. So you can attempt part A. Yeah. Now, navigator. I am assuming you have attempted the part A now. You went on to the part B. Oh, 7 audit risks. And you thought, okay, let's check out the part C first. I'm assuming you did not attempt the part B. So straight away jump to part C. Yes, you can attempt the part C. It is also a bookish knowledge. What about part D? Explain the difference between interim audit and final audit. Explain the procedures which are likely to be performed during an interim audit and what impact it would have on a final audit. So what is the difference between interim? You can attempt the part D and E over here, somewhere here, and you're not, maybe you have skipped the part B. Is this clear, Vikil? Oh, most welcome, Vikil. Clear. Okay, Swati has got a question from where we have to prepare bookish knowledge, BPP or Kaplan or from anywhere else. Well, Kaplan book is more than enough for bookish knowledge. If you guys are going to incorporate BPP book in your exam preparation, it is going to take a lot of time and energy. So it's better off to focus on the CRQs. It's better off to invest time and energy on the practice platform. So attend the lecture which is available on the VIFHE portal, and then move on to the practice platform. Consult the solution, type the question, type the answer. Can you please explain the last audit risk regarding the finance cost? If the client has borrowed a new loan, the first risk is about the fact that there is a risk that the management has not correctly made the split between the current and the non-current liability. Moreover, the associated disclosure could be inadequate. So that's the first risk. The second risk is because of the additional loan, because of the additional amount borrowed, one would expect that there will be an additional finance cost, the interest expense. There is a risk that the additional finance cost is not charged in the profit or loss account in order to overstate the profit. So as a result of that, the profit would be overstated. Is this clear?
Sir, can I add something to it? It's my question.
Yeah, please go on.
Sir, like you told us, a half an hour ago, like there is a difference between the business risk and the audit risk. So when we
Yes.
talk about the profit, the overstatement or understatement, so at sometimes we always like incline towards that business risk. But this in this particular situation, like you told us that there is a omission of finance cost, could be possibly the situation. So and we're talking about the profit. So I just want to know what is the thin line difference between the
Yeah,
both the risk.
I got it.
Yeah.
See, I am bothered about the fact that what if profit is overstated? It means the account would be giving a wrong impression. The financial statements will not be reflecting a true and fair view. I'm not bothered how to improve the company's profitability. So there is a clear line, I would say.
Okay, sir. Like we
Please,
have a doubt that there
yeah,
could be a
yeah, I'm concerned about the fact what if Amazon company has not charged the finance cost in the profit or loss account, and as a result of that, the year-end profit would be giving an incorrect impression. The profit would be overstated. So I'm having a fear or doubt in my mind. I'm having that apprehension in my mind that the year-end profit could be overstated. Why? Because the finance cost is not charged in the profit or loss account. It's a breach of the relevant accounting rule or standard. Yeah, because according to the rule or standard, if you have obtained a loan, you need to charge the proper, you need to charge the finance cost. So I'm not concerned how to improve the company's profitability. I'm not concerned how to make sure the company's profitability is maximized. So there is a clear line. We when we are discussing, there is a risk that the additional finance cost is not charged by the company. I'm bothered about the numbers, about the integrity of the numbers. I'm not bothered about the overall company's profitability. I'm
okay, sir.
thinking like an auditor. I'm not thinking like the company's CEO. Is this
Okay,
clear?
sir. Yeah, yes. Sir, one more question. Can I ask now?
Yeah, sure.
Sir, you told us that it is not necessary to write the headings of a particular audit risk. So do we
Yeah.
need do we need to write those headings, or can we start with the explanation of the
No, no,
audit
no, no,
risk?
no, no. You need to come up with two headings: audit risk, auditor's response. That's it. And then obviously your answer. If your audit risk has got to do with inventory valuation, don't give heading inventory valuation. If your audit risk has got to do with provision, don't give heading provision.
We need to explain directly straight away.
Yeah, you need to
Okay.
extract a portion from the question itself and then highlight which financial statement items are at risk and then explain your doubt, or maybe you will be authoritative to say this is not in line. For example, in heart, there is a risk that the intangible asset could be materially misstated and that non-current asset is overstated because they have incorporated the maintenance cost within the capitalized cost within the tangible non-current asset. That's the difference, but there's no need of heading.
Okay. Thank you, sir. Thank you.
Any other
Yeah.
question from anyone? You guys are more than welcome to use the chat box. You are more than welcome to use the mic, and you are more than welcome to use the WhatsApp group. I think I'm the most vocal person in the WhatsApp group. Can you please pin that WhatsApp group? You know what? WhatsApp allows you to pin 3 chats. So if somebody has already pinned something else, okay, good for you. I wish you all the best for that. But can you pin me for few days till the exam day? Then you can unpin me, unfollow me. Please pin the WhatsApp group. Those voice notes which are regularly sent in the WhatsApp group are important. And I always send those voice notes with this hope that somebody somewhere around the world will realize that the bread and butter, the ACCA, is at stake. And if he or she is going to work harder, all that hard work will eventually pay you off and you will shine like a bright star in the future for you, for your current family, for your potential family. So, so please pin that WhatsApp group. So if you have got any other question, please raise it now. Otherwise, I need to take your leave. This was a very important class. Ramla, what question? Are we support? Are we supposed to finish planning part videos on portal bio? Okay, Today is Wednesday. By all means, you guys need to start the fifth topic, internal control systems, the second major topic. First major topic, audit risk, from Friday morning and onwards. So you have got couple of more days. Okay, worst come scenario, Saturday morning, internal control systems. Saturday morning. So you have got couple of more days to brush up your risk, to finish off your auditors, type all the CRQs, don't feel overconfident, try to realize what audit risks are so repetitive. Be the master of them. So Ramrao, thank you very much for raising such an important question. Please, guys, please move on to the second major topic from Friday morning, or worst come scenario from Saturday morning, and don't wait for your ACCA result. Whatever the ACCA result is going to be, we have to attempt double A. That's for sure. Think about double A or triple A, whatever. So on next Tuesday, we are going to have our live class. Yeah, Tuesday or Wednesday. Well, probably on Wednesday. Yeah, Wednesday. Now, before I finish off today's class, a very time-consuming class, I would say, the last thing which I would like to highlight before I take your leave. Guys, you know how interested I am when it comes to Section A OTQs. So what about OTQs? Well, there are 5 OTQs in the Kaplan kit with respect to planning and risk, 51 to 75. So within your VIFHE's portal, all those 5 questions are available. I'm dead sure about it. I think there is a class within your portal, and it's called, I think it's called OTQ class 3. And that covers 51 to 65. And there is another class which is called OTQ class 4. I might be wrong with the number. Maybe it's OTQ class 4 and 5 or 3 or 4. I'm not sure. But I'm dead sure 51 to 65 are available. And I'm super dead sure 66 to 75 are also available. So is there anyone who has already covered those 2 classes? Is there anyone who has already covered? Oh, wonderful. Yes, yes, yes. Loving it. Oh, another yes. Well done. You know what? If you are absolutely clear, evidence is under what chapter? Evidence would be covered when we are going to have a go at the major topic number 3, substantive procedures and evidence. The major topic number 2 is internal controls. Now you need to move toward internal controls. So guys, before you move on to internal control systems, you have to make sure you are done with those OTQ class 4 and 5 as well. We cannot underestimate the importance of section A type questions. I wish you all the best for your double A. I hope you will stay aggressive for your double A. I hope you are not going to be, you're not thinking about your result. I hope your upcoming result will not affect your aggressiveness and your dedication towards this exam. Don't waste your next 4 to 5 days thinking about the result. Stay optimistic, stay aggressive. I wish you all the best for your result as well. So thank you very much. And thank you for joining in. Take care. Stay blessed. Bye-bye. Thank you. Thank you, Ramla. Thank you, Tess. Thank you, Farah. Thank you, Joseph. Thank you, Caroline. Wickles, everyone. Thank you, Simpy. Thank you, everyone. Thank you very much. Bye-bye. Yeah. Bye-bye. Bye, sir. Bye. Well, before I finish off today's class, what if you guys attempt uni all over again? And as far as Darjeeling is concerned, because you guys have raised this concern that Darjeeling is not available, I would like to have a go at Darjeeling pretty soon. Maybe I might have another live class on coming Saturday and we'll explore Darjeeling. What about that? So prepare all the questions and then we'll see. I'll update in the WhatsApp group. Don't worry. Thank you.